The 2008 housing market crash was a huge financial disaster.
We're down by between 3 and 4.5% generally across these markets.
Let's talk about the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
And The Big Short does an incredible job of showing how it all went down. The film explains the complicated financial products that fueled the crisis and brings us into the lives of the few people who saw it coming. But some amazing stories didn't get as much attention in the movie. One of these stories is about Greg Lippmann. In one scene, he's trying to convince Ian to bet against mortgage bonds. Lippmann's department is heavily invested in these bonds, and he's been mocked as Chicken Little and Bubble Boy for warning about the collapse.
My whole department's long on this stuff. They call me Chicken Little. They call me Bubble Boy.
But the movie doesn't fully explain how crucial Lippmann's role was. He was a key player in creating credit default swaps, CDS, which let investors bet against mortgage-backed securities. Lippmann saw that the housing market was about to crash and wanted to make a profit from it. Then there's Charlie Ledley and Jamie Mai, who were not Wall Street big shots, but rather small-time investors running a fund from a garage. They stumbled upon a way to bet against the housing market and realized it was a massive opportunity. They found a bet even bigger than the one Michael Burry was making. Ledley and Mai's story is about smart thinking and risk-taking. They weren't experienced investors. They were just people who noticed the flaws in the housing market. When they approached Wall Street banks to buy credit default swaps, they were met with doubt. Who would want to bet against something as stable as the housing market? But Ledley and Mai saw the cracks in the system and understood that the market was about to collapse. Their gamble paid off big time. As the housing market fell apart, their credit default swaps became incredibly valuable. By the end, Ledley and Mai had turned a modest investment into a $135 million profit. It was a remarkable achievement for these two outsiders who took on Wall Street and won. While the movie highlights some of the big names, it's the lesser-known stories, like those of Greg Lippmann, Charlie Ledley, and Jamie Mai, that also reveal the depth of the crisis. Now let's talk about one of the most memorable scenes in The Big Short. He's playing us. This scene is famous not just for its humor, but also for explaining the complicated financial products that fueled the mortgage bond market collapse. Even if someone hasn't seen the movie, they might recognize this clip because it clearly outlines the risky bets made by investors like Michael Burry and Steve Eisman on the housing market's failure. What the scene doesn't fully cover is the shady side of Deutsche Bank's involvement. Greg Lippmann, played by Ryan Gosling as Jared Vennet, was a trader at Deutsche Bank. The film does show some of his eccentricities, but misses the deeper details of his role in the crisis. Lippmann was known for his unusual approach. One of his former bosses described him as an effing whack job, which hints at his unconventional methods and high-stakes strategies. The problem started when commercial banks lent money to families who couldn't afford it. Investment banks then bundled these risky subprime mortgages into financial products called collateralized debt obligations, CDOs, and sold them to investors. In 2007, Lippmann found himself presenting this risky bet to Front Point Partners, an investment fund run by Steve Eisman, who is portrayed as Mark Baum in the movie. Eisman's team was made up of Vinnie Daniel, Danny Moses, and Porter Collins. Each member brought a unique skill set to the table. Moses was Eisman's head trader with a background in sales. Collins was a former Olympic rower, and Daniel was the research guy with a sharp eye for skepticism. Daniel was particularly wary of Lippmann's pitch. After all, Lippmann was asking them to bet against bonds that Deutsche Bank had created. It seemed odd for someone to be selling a bet against a product his own firm was involved with. But Lippmann's angle was straightforward. He was playing his part to help Deutsche Bank profit while shifting the risk to AIG. As a bond trader, Lippmann stood to gain substantial fees as the bonds began to fail. Lippmann's bet was similar to the one Michael Burry had made. He was buying CDS on the riskiest, lowest-rated slices of subprime mortgage bonds. To illustrate, imagine standing in front of a burning house and offering fire insurance. The logic was simple. Home prices in the U.S. had soared in the last 3 years, more than they had in the previous 3 decades. Many new homeowners were defaulting on their mortgages within just a year, which meant they should never have been approved for loans in the first place.
Let me put it this way. I'm standing in front of a burning house, and I'm offering you fire insurance on it.
Lippmann's strategy wasn't just about making money. It was about capitalizing on a failing market while cleverly shifting risk onto others. His role highlighted the financial engineering and risky bets that contributed to the crisis. Imagine you're betting on $100 million worth of bonds. At worst, you'd spend $12 million over 6 years. At best, you'd make $100 million. That's exactly what happened to Steve Eisman's firm, Front Point Partners. Their investment strategy grew their assets from $700 million to a staggering $1.5 billion. Eisman alone earned $47 million in 2007 for his trading feats at Deutsche Bank. The returns from their bets were astronomical, proving that the financial sector can indeed reward bold moves. In 2002, Capital One stock plummeted 60% in just 2 days after regulators uncovered fraud within the firm. Charlie and Jamie decided to investigate the company themselves. They concluded that the market had overreacted and that the management team at Capital One was not as bad as everyone thought. At the time, Capital One stock was trading at $30 per share, but call options were available at just $3 each. They bet $26,000 that Capital One stock would rise above $40 per share within the next 2.5 years. They were right. Their $26,000 bet turned into $526,000. Charlie and Jamie's next bet was even bolder. They invested $500,000 in UPC and turned it into $5.5 million. Their investment strategy was high risk, but their intuition was spot on. They managed to turn $200,000 into $3 million with another bet. By 2006, they had transformed their initial $100,000 investment into a remarkable $30 million. By August 2007, Charlie and Jamie's initial $1 million bet had turned into an astounding $80 million, boosting their fund's value to $135 million. That's a more than 1,000-fold return in just a couple of years. After the crisis, Charlie left Cornwall Capital in 2009 to join Highfield's Capital Management, while Jamie stayed on as CEO and CIO. According to reports, Cornwall Capital achieved an impressive annual return of 52% from 2003 to 2012. Despite the high stakes, these financial mavericks prove that, with the right insight and timing, even the most unlikely bets can pay off big. Their success stories continue to resonate in the finance world today, showcasing the power of daring decisions and sharp intuition in a time of market turmoil. Thanks for watching. Please like the video, subscribe, and share your thoughts in the comment section.